What's up traders, Tom here with another video. Today we'll be talking about Warren Buffett, our technical analysis thoughts on the S&P 500, and what's happening in China that should possibly start to make investors concerned. Will history repeat again? Stay tuned. In this video, we'll be talking about the latest stock market news, as well as a quick lesson in cycles of the market. How you need to start thinking about the market participation from a price action perspective. I think everyone will enjoy this episode. So our story today begins with Warren Buffett buying. It's almost amazing, yeah? During this crisis, he has not been purchasing much. In fact, he's been a seller, but he has purchased now Dominion Energy gas assets for around $4 billion. As a comparison to his overall cash holdings, obviously this isn't much, and Warren and his team will need to invest more in the future, which I'm sure they have some plans for. But it's interesting to see Warren making a move like this into, of course, an asset class that is deemed at the moment not that good or healthy. I also want to talk, before we get into the rest of the technical analysis, just about this concept, which is, of course, one of Japan's largest employers plans to cut office space by 50%. Think about things logically and you'll always make better investment decisions. And that goes for technical analysis as well. Key psychological zones, all of that type of stuff. If we see more people working at home, we may see less demand for office space. So if you're thinking about investing in commercial office space, make sure you pay attention to what's happening, as I think this will be a bigger move over the next coming decades. So let's get into the technical analysis, the stuff we're all here for. So here is the Shanghai Composite, and it's almost like deja vu for me. I've been trading the markets for a long time, and we are seeing some bullish, aggressive action on the Shanghai Composite. Look at these 4-hour candles. It's almost like Superman taking off. And this is one of the things I kind of like about some of the Asian markets. When they get bullish, they get ultra bullish. But we do need to be wary of crazed valuations in these stock markets. I'm going to actually go to a weekly. I'm just going to zoom out for a minute. And for anyone that's not aware, take a look over here. The market went from 2,000 to 5,150 in only like 12 to 18 months. It was a massive bubble back in 14, 15 into 16. For any investors that aren't aware of this, it's always worthwhile knowing about the bubbles of the past. Remember, this happened relatively recently. We had the Bitcoin bubble into the Bitcoin crash as well. We have had bubbles only just recently. It's amazing how they can happen time and time again due to cycles and due to euphoria in the markets. So are we going to be heading from that again? Well, we're definitely not out of the main zones yet, because really, I've been kind of thinking about this for a while, and I've always thought that potentially the Shanghai Composite was a little bit undervalued, and it still could be over the long term. In fact, we still aren't even at this 3,600. That will be the key level to look at. Look at the resistance over here and the resistance over here. So we've broken out. We're about to close above the 3280, and if it goes up further, we would expect it to go to around that 3600. If it continues to rise at this pace though, that always has me worried about asset classes just in general for the world. So always pay attention to that. So one of the lessons that I want to talk about before going into this S&P 500 technical analysis fully is talking about market cycles. Now there are many cycles, and there are cycles within cycles. Obviously, we have the multi-year approach cycles, which are very, very effective for investors, where we have the accumulation phase, which is where all the smart money gets in. We have the markup phase, or the public participation phase, and everyone getting involved. We have that end kind of euphoria stage. Then we have the distribution stage into the decline or the markdown stage. Now, this is generally what you see in markets or what you are looking at. But there are several of these cycles within cycles, and that's what I wanted to talk about. If we go and have a look at the S&P 500, we actually have a cycle going on right now. I'm actually going to go over here to the left though and just talk about the previous kind of pullback that happened from 2018 into 2019. So the reason I want to bring this up is we have a trough down here, and then we have a peak here, and we have a higher trough just over here. Now, I talk about this all the time. I talk about this idea of a change of trend. So generally what you will see in a market is you'll actually see that the market will come down and it will test the previous lows, and then it might bounce off and it will create what's called a double bottom, where the equal lows are basically tested. The market finds that there is value there. There is a huge amount of buying support there. And then that buying support and possibly less bad news or whatever else is happening pushes the market up and people start to participate in it. When it breaks past this previous peak, that's kind of like your go-to. It's like, yes, we need to be in the market. And that's when you see everyone start triggering their orders. There's often a very aggressive kind of takeoff from that zone as people realize it's time to buy and time to get in for the longer term holds. The other thing that can happen is that we see a market do this, where it basically stays in a sideways action, and this is the accumulation phase. It's actually one of my favorites because when you see strong accumulation breakout, it's often very aggressive and it's very accurate, especially in the stock markets to the long side. It's one of those kind of key things where you see this happen, it's really considered that level. Market participants have come in and the buyers are ready to go because that market is broken for a key reason. So what we then see is we see the peak here get broken and confirmation close. So what we're starting to have happen is that the market is faster than it's ever been before. The market moves from the trough to the peak to the higher trough kind of phase. It often doesn't even come back. It might only go to a 38.2 fib or a 50% fib, as in it only comes back 50% of the previous move, and then it boosts off and keeps going into that participation or markup phase. That then phase continues to go up, and even once we hit things like resistance up here, and we can see it did act like resistance, we often go into full excess phases very quickly, where basically the market continues to go up into the highest resistance, even breaks that resistance slightly often, and then it will pull back in the distribution phase into the markdown phase. So this is what we've been seeing, and we've only been seeing these kind of triggers. Faster triggers, harder to get into. So learn about change of trend and always focus on the key timeframes. Daily, weekly, monthly really matter on indices. They really matter. I can't stress that enough. Even if you're trading a 15-minute chart, if you're not aware of where those daily, monthly, weeklies are, you could get into trouble. So let's have a look at the most recent example. Well, we obviously had a trough down here, we had a peak here, and then we had a higher trough broken out by this candle here. Sound familiar? Well, it's the exact same signal that we got during the last crisis. We got during that 18 into 19. Then after that, we have a very interesting candle. I'm actually going to zoom in on this candle because I want to talk about this candle a lot. So here we have what I guess some people would call a pin bar, or some people would call it a shooting star. So when we see this kind of candle, we need to be very well aware that this candle by itself, while it does show that the market sellers have started regaining control, you need to see follow through from the next week. You need to see new lows formed and actually a confirmation. The reason why? Everyone knows about this candle. It's no secret. It's one of the first things retail traders learn. The stock market is very well aware of that. And while it does show negative connotations to the market, negative sentiment, it doesn't show statistically. I think the statistics on the candle like this is only about 53%. So it's not that good. It's one of those ones where you want to use further information before you get into any trade like this. So just be warned of that type of candle. So then we see that the market is broken out and it goes into that participation phase. Now, what's happened recently? Well, during this participation phase, we usually hit key areas where we see distribution. So we've seen the distribution here and started, and it makes sense. If we actually draw a Fibonacci retracement on this level, take a look at this. The reason why everybody was talking about this level, and I mean everybody, is because it was hitting a key 61.8 fib at the same point as you had previous support and previous resistance. In fact, the Dow was showing it even better at this 61.8. This was usually the key area where you would see market sell-offs, and it made sense that the market was distributing at this phase. The quick participation, very, very quick in this market nowadays, into distribution. But what we're seeing now is the participation has continued into like an excess phase. So the market has actually gone even higher, and we've started to see that euphoria appear in the market. Euphoria is equal to usually the market kind of overextending. Can it overextend for a long period of time? It certainly can. But what we're seeing here today is that the market is in a key kind of zone, and we've talked about this quite a lot on the channel. So we've talked about how the market is pretty much trapped within this 3,000 to this 3,230 zone. The futures today are looking bullish. In fact, it's looking very bullish. But remember, it's all about confirmation close on the real market. Let's switch over to the real market right now. So here we have the real market, and we can see that it looks very different from a price action based standpoint. Until we see the market close above this zone, it's unlikely that we have a true trigger to see that it moves to the next level and then potentially goes even higher up until this resistance. Expect when it hits this resistance that it might break it slightly and then go into another distribution phase. And the reason it's going to do that is there's going to be a lot of profit up here. So if it does break through here, gets through this zone, there's going to be trading opportunities where the market will do something like this. It'll go like this, come down potentially, break up, come down, test the previous resistance. That will then potentially be picked up again, and we'll talk about it on this channel. And then this resistance over here will act as, of course, selling pressure. Now, the other thing that can happen is that we see a continuation of this distribution where the market comes up, hits this resistance, finds selling pressure, and then potentially even goes back down and tests this level. Remember, we talked about how it may be in a kangaroo kind of market where the market will be up and it will be down and it will be sideways and everywhere, as we see some companies do well and some companies do poorly during this crisis. It also makes sense from the Fed's perspective, because remember, the Federal Reserve is trying to manage this crisis and they're reducing their asset sheet each week because they're pretty happy with probably where the market is right now. So when we take all of this into consideration, what really I'm trying to get to is you can understand the cycles of the market, but what you want to really understand is that when the key price action happens, e.g. the change of trend on a bigger time frame, and you know that the market's bullish, what you then need to do is you need to recognize when the market breaks key zones. Now over here, remember we talked about how the Fed has been very good at managing to get into the market and stop trigger points. If we saw the 2800 break low, that was a trigger point where we would have a double top. Remember, we have equal resistance here with an intervening trough that never got broken through, because guess what? Fed came in over here and said, it's okay, we've got the back, don't worry, because they stopped the trigger from happening. It's literally manipulation from that aspect. Again, we almost saw it over here. We saw a peak, a trough, a lower peak, and potentially, guess what? A lower trough. Now, if we'd seen that, what do we think? Well, that would have been a trigger sell point. Guess what the Fed did? Well, they said, no, Fed's here, don't worry. We don't want to get involved in this. So they really have been manipulating the sell signals in this market. It's very important. If it ever happens though, that's why there's such critical sell points, because these are the kind of things that you generally see in the market after those phases. And the phases can be very quick. In certain instruments, the phases can be multi-years. The phases can be very short on shorter timeframes. But when you start to think about it from this thing of when the trigger happens and the accumulation ends and we start to see the participation, look at the price action for the next take profit levels, for the next area that you expect the market to potentially go into distribution. It's very important to think about. So let's jump back over now to the futures and talk about what's happening now. Well, we've seen that the pre-futures are actually showing 31.81 here, and the market's actually just opened, and effectively we are breaking to a new high. Remember, the candle must close, as in the real market must close for the day above this zone. It can very easily just do this and come back down. Will it? Time will tell. But be patient as a trader, be patient as an investor. It's the best piece of information I can give you. If you're patient, you usually will get a key. Now, if you're holding a stock for 10 years, obviously you want to be in it, but patience is the key here. The market often will come back down. It will test the previous resistance in role reversal and give you the opportunity to get back in to the long side if that's what you want to trade for. So always think about that, and even think about that as, I know there's a lot of options traders here. Imagine if you could pick it up here where it's going down, but you knew that statistically it was more likely to go up after that. you can take advantage of spreads, take advantage of different options and different strategies. Very important when it comes to these kind of trades and these type of analysis thought points. What's happening on the US dollar? Well, we always talk about risk on, risk off sentiment. Here we have the trend line potentially getting closed. I say potentially because it hasn't actually closed yet. We haven't seen the daily close. We don't know what's going to happen. I talked about how ascending triangles like to fail and what usually happens where they come down, it comes up, tests that trend line, and then sells off. I would expect it to probably go to something like this 96.50 zone, bounce off that, and if it was able to sell off this zone with a change of trend on the smaller time frame, come down and test the 96. Very important zones for the dollar index, and we'll follow it over this week. So if you found this video informative, please subscribe, obviously hit that bell, and we appreciate a thumbs up on the video. Thanks very much, everybody, and we'll see you in the next video. Happy trading.